Hey everybody, it's Carmasino here at Chaikin Analytics. This is the halftime show on StockCharts TV. We do this each and every week in the middle of the day. That's why we call it halftime. It's about 1:15. And we'll kind of go over the markets. We're going to look at the power gauge on a few different areas. But, coming into year end, the primary focus is really on the market, the mechanics of the market and the market in general. So today we've got another sell-off. I mean, look, we talked about the NASDAQ, the S&P, a few of these indices that have, had some big pushes higher, but those moves higher have, acting more like a bear market rally than a bull market. So that happens, and you've got to be cognizant of that, and you have to be aware of that. Now you've got some year-end manipulation and recalibration going on, and I say manipulation not in an illegal sense, more of a sense of moving assets into either better performing or moving out of the underperforming ones, moving to cash, or potentially even taking advantage of higher rates. Now that's institutions and small investors, retail investors alike. So you got a lot of churn, you got a lot of movement going around, and you're going to get volatility, but the direction specifically on the NASDAQ is negative. And we'll look at that chart. I'm going to expand that all the way back to 2001 and talk about an indicator that I kind of looked at and almost stumbled across, really, and it's the ratio of the NDX over the SPY. Now, that's an index over an ETF. I understand that, but I wanted to look at the total return and kind of look at what the mechanics of the direction look like. So we'll talk about that. And really, coming into year end here, I want to thank everyone for watching this week to week. And in the next few weeks, we're going to have sort of an overview of Chaikin Analytics, the system and the way we use it, and some of the functionality. And so tune in for those in the next couple of weeks. They won't be really market commentary, but you'll be able to see how the system works, because the next 2 Mondays are holidays, and you know what that means. It's Merry Christmas time, Happy Holidays, and Happy New Year to everyone. And we're looking forward to continuing the show in 2023. So let's take a look at some of the charts and see what's going on today. All right, everybody, we're here at the ACP platform for StockCharts. And this is the ratio that I wanted to call out that I just talked about here in the beginning of the video. And it's up top here. We've got the NDX, the NASDAQ 100. As you can see, the longer term view. This is a weekly chart. Just keep that in mind. And I'm kind of focusing on some crossovers and some bigger action looking at the ratio. Now, I realize these moving averages, the 15 to 200 day had crossed in previous times here prior to the 2001 that I'm going to reflect on. But these were sort of when the index was in an uptrend. Right. We weren't having any kind of major pandemics or incredible stimulus packages other than 08, of course. But even in 08, this is when the weekly chart was starting to turn up. And that was right around the April timeframe. And even when the market bottomed, let's think about this for a second. Even when this NASDAQ kind of bottomed in the whole, even the S&P, when that bottomed in March of 2009, this ratio, again, the index to the SPY, was in an upward trend, okay? What's alarming to me is I'm seeing this ratio cross to the downside on the moving averages, as it did after a very large run-up in the late 90s and early 2000s. And then we had a significant downtrend. Now, if you look at my crosshairs, that coincided with the 55 EMA crossing under the 200 on the index itself. We're not there yet, but we're pretty close, right? Closer than we've been in quite a while. And really the last time that did happen was toward the end of 2008. And we know what happened in that last quarter of 2008. And so we had a double bottom here on that NASDAQ, and it really ended when the entire S&P ended. But the ratio started an upward trend prior, and both the NASDAQ and the S&P bottomed around that March 9th time frame on 2009. Now we're in a different time frame here, and this is what I'm looking at. So I'm calling that out because I wrote a note here on the 15th, and so in between when we produce these videos and get them out to you, go to the Power Feed, subscribe there, and get some, daily commentary. And I kind of made a big headline about this, saying the making of a tech wreck is ahead of us. But I just went back and talked about what unfolded back in those times. I'm kind of seeing the same thing, happen again. So I'm calling them out, not to make, again, a prediction, but more of a projection. I like to use that reference because I don't believe we're making predictions here. I'm just kind of following the trend and looking what happened last time and what the possibilities are. So you've got to do the same. So let's move on here. Looking at the S&P, at the bullish percent ratios. I don't know if you remember me doing this. I did this for quite a while, most of this year. And I've been calling out the rallies, again, on a weekly basis and looking at the bullish percent as sort of a guide of what's happening. The bottom here is the S&P. The middle is the NASDAQ. And the top here is the larger composite, the New York Stock Exchange composite. All are showing decreasing trends here in the last few weeks. And there's that rally kind of rolling over right around that wedge, that I drawn between some of the downward trend and the upward trend here back from when we had the pandemic sell-off in 2020. And so it looks like it's, potentially going to be rolling over, at least testing this area. That would be pretty low. And it's already at 38.32 as I'm recording. But, that would be another few hundred points here where that could potentially bottom. And if it puts in a new bottom or breaks this previous low, that could be potentially a lower low materializing. You just got to be aware of it. All right. I'm not making any predictions here other than the fact that, we've been looking at this head and shoulders pattern, how it's played out a few times. Let me adjust my charts here. Forgive me for not doing this prior. I thought I had it saved properly. But I just noticed another head and shoulders kind of forming here. And if I'm looking at this target from this neckline, it's around that 3,300 level. And that's not an unusual target. A lot of people are kind of getting there using different formats, using earnings projections and PE ratios of the S&P. And so it's all kind of, I don't know if it's self-fulfilling, but it's kind of all lining up in that same area. So again, if we break this area, this 3775, 3800, I would think that we're at least approaching previous lows and potentially new lows. So you got to be, kind of keep that in perspective. This is one, obviously, we've talked about oil many times during the course of the year. I got two charts here. This one I thought was a little bit more interesting just because look what happened with oil when it has moved into this range, which I'm calling the White House buy zone, which was $67 to $72. We talked about replenishing the strategic petroleum reserves. And oddly enough, when that was called out, oil moved right to that range and bounced. And so I think that's going to be supported. I don't know for sure. Just looking at some of the sectors here, looking at materials, kind of rolling over a bit, but I do like the ratio. Again, the XLB to SPY has been pretty productive. Concerned about XLE, certainly. It has kind of rolled over, but it's rebounding a bit today. And, you're looking at that top formation rolling over. The trends haven't been broken, but it does look to be long in the tooth, so to speak. The rally's been going on for quite some time. Again, I'm not in the camp saying that oil is going much lower, but I'm just concerned that people might be using this as profits to find other opportunities. And that's kind of what, we worry about. It's called a proceeds trade, right? You're selling one thing, using the proceeds to buy another. And maybe that happens in the first quarter, right? They might not want to take those gains this year, but those gains might start to get taken in the first quarter. Financial is kind of the same thing. Been a tough one to really understand just because rates rising, we would think help the financial sector quicker and certainly on a material basis, but it's not been the case. And you're starting to see this particular sector roll over as well. So again, the sectors are kind of giving us mixed signals for sure. What's not giving us mixed signals is probably defensive sectors, which a lot of people are kind of touting. And the first one you got to think of is consumer staples, right? This is the stuff that we need, not the stuff that we want. The other one is utilities, which we use every single day. I'm using right now while I'm recording this, right? Our electricity is running here, and utilities are rebounding a bit. And obviously, the other one is healthcare, XLV. That ratio is also firming up and looking a little bit better, but it is not been perfect. It's been volatile as well, but the ratio is working and doing its job, where the individual sector seems to just be having trouble breaking into new highs and holding onto that traction of an uptrend. But again, it is doing its job. So you got to pay attention to those defensive sectors. All right. And that's kind of what, we're seeing right now from a sector review. Okay, just jumping into one more sector that we haven't talked about in a while, which is semiconductors. And I can look at SMH here versus the SPY. And what I did here was just break them out as well. So you've got the ETF here, SMH, and you've got the SPY down below to kind of see the direction. So, both are heading in a negative direction, no doubt. Both are in a downtrend, and even the ratio is obviously going to be in a downtrend. That means at certain points of this ratio, SMH was leading the SPY lower, and in certain areas, SMH was outperforming the SPY based on a percentage basis. So you can just see that step for step, it's been lower highs and lower lows here, and this consolidation range here, is looking to be pretty steady, but again, just not seeing that type of traction that we like. Now, I like to see these moving averages converge, and we're seeing that more specifically on the sector fund, this semiconductor fund here, but the S&P is kind of keeping that range as well. And if I go over to Chaikin, and we have the ability to pull in the ETF and look at all the constituents as well. And this one is more bullish than bearish. We got 8 bulls to 3 bears. Maybe that might be hard to see. That's why I'm reading it for you. And looking at this one down over 1% today, but we're in that downtrend, right? So the trend is reflecting this particular moving average here that we use. It's double exponential 200-day, and it's flattened out, but money flow has not quit, and neither is relative strength. And you can go back to this particular chart and see that the relative strength, obviously, here has been a little bit better, and this move from this ratio low of in October to the recent high just a few days ago, that's what's building this better outlook here, right? It's just not getting out of the particular range that we've been seeing it in. So the range has been around that 230 or so down to around the 180 to 200 level. And obviously anything below this would obviously, start to be troublesome. Inside the names, there's not many bad looking charts. There's just as many not good looking charts either. And it's kind of like a mixed bag. And that's why we're seeing this sort of more neutral rated names in here. The best looking one that I saw was AMAT recently, AMAT, and it kind of reflected the overall sector fund itself. Again, large relative strength change. It looks almost identical, a better upward sloping particular moving average. And just looking at the metrics here inside the power gauge, still quite expensive when you look at a price to sales ratio. But when we rate them and rank them, it's more price to book that's holding back the fundamental rating, even though we're looking at a very bullish setup. But when you start to look at that price to book, 7 times book, again, for a semiconductor company, I'm not exactly sure that that's very high, but at the same time, it just seems to be a little rich. And I think the market is sort of trying to get its arms around valuations in general. Folks, that's all we have for today. Again, happy holidays, Merry Christmas, and a Happy New Year. We will see you next year for our next live and up-to-date halftime show. In the meantime, enjoy the next couple of weeks, kind of learning about the Chaikin system, and we'll be back in January. Take care, everybody.